All right, imagine you have precisely $100, not a fortune, but a start. You're looking to invest it, aiming for growth by 2026. Two popular names surface, QQQM and VOO. But for that single Benjamin, in just a few short years, which ETF stands a better chance of boosting your $100 investment? Let's dive deep into their fundamental differences, investment strategies, and what you should genuinely expect from each by 2026. We'll explore their unique compositions and how they might perform, helping you make an informed and crucial decision for your initial foray. Let's begin by understanding what we're actually comparing. QQQM, the Invesco NASDAQ 100 QQQ ETF, tracks the NASDAQ 100 index. This index comprises the 100 largest non-financial companies on the NASDAQ. Think big tech, innovation, and high-growth sectors. Apple, Microsoft, Amazon, Google, and Nvidia dominate. VOO, Vanguard's S&P 500 ETF, tracks the S&P 500 index. This index represents 500 of the largest U.S. publicly traded companies, offering much broader market exposure. While it includes tech giants, it also encompasses diverse sectors: financials, healthcare, consumer staples, industrials, and energy. So from the start, we're looking at focused growth versus broad market diversification. For a $100 investment, this fundamental difference is crucial. You're choosing between a highly concentrated bet on leading tech and growth stocks or a more balanced representation of the overall American economy. Your choice dictates the risk and reward profile of your small capital. Now let's zoom in to QQQM. This ETF is essentially a lean, tech-driven growth machine, a slightly smaller, more cost-effective version of the popular QQQ. Its primary appeal lies in exposure to companies that have historically driven significant market returns through innovation and rapid expansion. Think about the last decade. Technology stocks frequently outperformed other sectors, propelling the NASDAQ. If you believe this trend of technological advancement will continue strong through 2026, QQQM could be attractive. However, high growth potential comes with higher volatility. When the tech sector experiences a downturn, QQQM feels it more acutely than a diversified fund. A $100 investment means your small capital is highly susceptible to the concentrated performance of these top 100 companies. While substantial percentage gains exist, the downside risk is equally present. Investors choosing QQQM are betting on continued outperformance of a relatively narrow market segment, requiring strong conviction in tech's future trajectory. Shifting focus to VOO, we encounter a different philosophy: broad market exposure and diversification. By tracking the S&P 500, VOO provides a stake in 500 of America's largest, most established companies. This inherent diversification across 11 different sectors helps mitigate risk. While tech still plays a significant role, it's balanced by substantial allocations to healthcare, financial services, consumer goods, and industrials. This means if one sector performs poorly, the impact on your overall investment might be offset by stronger performance elsewhere. VOO is often considered a core holding for long-term investors due to its stability and consistent, albeit typically slower, growth compared to tech-heavy alternatives. For your $100, VOO offers a set-it-and-forget-it approach, providing exposure to the entire U.S. economy's health. Explosive growth might be lower than QQQM in a tech boom, but the risk of significant downside from a single sector crash is considerably reduced. It's a choice for those prioritizing stability and consistent returns over aggressive, high-risk growth. Now, let's address investing just $100. In the past, this amount might have been too small. However, with widespread fractional shares through most modern brokerage platforms, investing $100 in either QQQM or VOO is entirely feasible. This means you can own a portion of an ETF share, allowing your small sum to participate directly in market movements. The key takeaway for a $100 investment isn't getting rich overnight by 2026. It's about initiating the habit of investing and understanding market dynamics. Both QQQM and VOO offer low expense ratios, crucial for small investments, as high fees can eat into minimal returns. Your $100 will grow or shrink by the percentage performance of the chosen ETF. So if QQQM goes up 10%, your $100 becomes $110. If VOO goes up 5%, it becomes $105. It's about starting small, learning, and consistently contributing more over time if you plan to build substantial wealth. So which is better for 2026? The answer largely depends on your risk tolerance and outlook. For QQQM, a bullish scenario for 2026 involves continued strong earnings growth from major tech companies, favorable interest rates allowing expansion, and sustained innovation. A bearish outlook would see increased regulatory scrutiny on tech, higher interest rates stifling growth, or capital rotation out of tech into value sectors. For VOO, a positive 2026 hinges on overall economic stability and growth across diverse industries. It benefits from broad recovery or consistent performance, making it more resilient to single-sector downturns. Its primary risks are broader economic recessions or prolonged market stagnation affecting the S&P 500. Given the relatively short time frame to 2026, market timing and specific economic events play a more significant role. Consider your confidence in tech's short-term trajectory versus the stability of the broader U.S. economy. Understanding these drivers helps. Ultimately, the choice between QQQM and VOO for your $100 depends on personal conviction and investment goals. Are you comfortable with higher risk for potentially higher rewards tied to innovative technology, or do you prefer the diversified stability of America's economic backbone? Before making any decision, even with just $100, conduct your own thorough research. Consider consulting with a qualified financial advisor to align your investment choices with your overall financial picture and long-term objectives. Understanding your personal risk profile is absolutely paramount.